I want to start with oil. You wrote a number of weeks ago that the risk of falling to 50 might be greater than the risk of rallying to 100. Has your view changed, Javier?
No, it has not changed, and mathematically, and I know this is a bit of a red herring, but mathematically, with Brent and WTI trading between $70 and $75 a barrel, we are closer to 50 than we are closer to $100. I believe that Israel has put aside his initial intention to retaliate against Iranian oil installations, and therefore we have removed a chunk of the geopolitical risk. The focus is still on 2025, more OPEC crude coming into the market, soft demand growth next year, and an oversupply market that doesn't require prices close to $100 oil.
Javier, when you look at the fundamentals of this story, we have Amin Nasser basically today talking about the fact that he's bullish on China. Do you see that demand pickup in China?
Amin Nasser is a seller of oil and one of the world's largest sellers, so he also always bullish about China. I don't think that the global oil demand is as weak as some people say. We are growing still around 1 million barrels a day, and that is quite remarkable considering all the amount of electric vehicles and energy efficiency that we are introducing in the global economy. But at the end of the day, the big problem is that OPEC bringing extra barrels into the market, the non-OPEC supply led by the United States, but not alone. Brazil, Canada, Guyana, other places, more oil coming into the market. At the end of the day, this is not just a question about whether China is strong, it's also a question about supply. You could have very strong demand and very strong supply, and therefore an oversupply market. And I think that when you put all together for 2025, we are going to have more oil that we are going to consume. Therefore, prices will need to be a bit weaker.
Okay, but let's look at the short term again and just look at the geopolitics of what's playing out. Do you think the market right now is pricing in enough the potential for an extended or war we are seeing right now in the Gulf?
No, the market is not pricing a significant disruption in Middle East oil supply. If we were to have a significant disruption in Middle East supply, say that we were to lose all the Iranian oil supply and perhaps oil from other countries in the region, say Saudi Arabia, the United Arab Emirates, Kuwait, we will have much higher prices. The market is not there, and I don't think that the risk is as elevated as some of the bulls try to paint. But yes, I do agree that if we lose a significant chunk of oil, then prices need to go much higher. That is not price.
How much is gold a geopolitical play versus a completely separate story entirely?
To me, it's a complete separate story. The main drivers is too much public debt around the world, high fiscal deficits, with some countries running based on a GDP fiscal deficit that look more like we are fighting a war, with countries that they are not fighting wars at the moment. So yes, there is an element every time that there is tension in the Middle East, there is gold, that's the safety, but I do think it's mostly a financial play, a fiscal and public debt. And the meetings this week in Washington of the International Monetary Fund and the World Bank are going to be having a big focus on public debt, and I think that probably is positive for gold.